Dividends are a really great way for us to grow our portfolios as investors. If we reinvest the dividends companies pay out, it can be a nice boost to our portfolios that compounds over time. Even if you just invest in ETFs instead of stocks, you can still get those companies' dividends paid out to you, or they can be automatically reinvested without you knowing about it, which is an accumulation fund. But what if I told you there was another type of dividend that nobody really talks about? And let's face it, who doesn't like getting some extra cash in their pockets? So let's talk about what this dividend is, how it compares to a normal dividend, the pros and cons, and how you can get your hands on them. Let's dive in. Believe it or not, there's actually over 7 main types of dividend, and even more when you break it down into subcategories. But the one most commonly heard of that you'll know about is a cash dividend. Cash dividends are typically paid from companies' profits, given in the form of cash payments. If you own shares in the company, whether it's through owning the stock directly or having it as part of a fund, you'll receive a share of the cash for each stock you own. How much you'll get is usually determined by something called dividends per share. This might sound complicated, but it's actually pretty simple. We take the total dividends paid and divide it by the total number of shares. So if we pretend that a company like Nike paid 10 million in dividends and it had 100,000 shares, we divide 10 million by 100,000 and we get £10 per share. Simple. Nike actually has 1.5 billion shares and pays varying amounts. So as you can imagine, it's never quite that simple and easy. The company will work out how much profit they have had and how much they want to give to shareholders, and you'll get that money paid directly to you. If it's within an ISA or a SIP, it will be tax-free and avoid dividend tax, something to be careful of if you aren't within a tax-efficient investment account. This has currently been lowered each year. Recently, it's dropped from £5,000 per year to a dismal £500, despite inflation, which is pretty crazy, so watch out for that. These dividends will typically be paid every quarter, but some pay once per year, some twice per year, and some will even pay you monthly. To be honest, don't get too caught up in that, because one paying you monthly doesn't mean you will get more money. It's likely just split between 12 payments instead of one, although the thought of getting dividends every month can be pretty exciting. In my ultimate dividend portfolio video, I broke these down and highlighted how May and September tend to be the best 2 months of the year for dividends because of how dividends are typically paid. So some months are going to give you much better payouts. It's important we address that because the dividend I want to talk about today works in a completely different way, and it's never really spoken about. And that is something called a special dividend. Now you're probably thinking, what in the world is a special dividend? Well, special dividends are one-time payments that companies issue to their shareholders. They are completely separate from the regular dividend schedule, and they're often a result of extraordinary circumstances. Unlike regular dividends, which are predictable and recurring, special dividends are sporadic. They're not something you can count on regularly, but when they do happen, they can provide a significant return. But it's important we understand the difference between the two types of dividends. So we've just talked about the timing. The special dividend is irregular and infrequent, while regular dividends follow a predictable schedule. The amount paid varies based on the company's decision. As with a regular dividend payment, it will typically be determined by a fixed dividend policy or a percentage of the company's earnings. These are usually defined within company meetings. The purpose of special dividends is often a one-time payment for distributing excess cash or windfall profits, whereas a normal dividend tends to be aimed at providing income to shareholders to reward them for their support. The market tends to react differently to both too. Because a special dividend is less common, having excess cash can be seen as a positive and can affect the share price. A normal dividend tends to be very predictable and doesn't tend to move things so much. The only time it does really move is if they've decided to cut or stop the dividend, which can be seen as a negative. It's also important to know that normally a dividend will typically drop once it's gone ex-dividend by the value of the dividend. This is because people who buy after the ex-dividend date won't be eligible for the dividend. This is completely normal and nothing to worry about. One of the difference between the two is that in most cases, a special dividend is typically treated as income tax rather than a dividend tax. But in the UK, that isn't the case, and they both fall under dividend tax. Again, if you do have them within an ISA and a SIP, you'll be completely fine, so don't worry. What we need to realise is that a special dividend, by its nature, is not meant to be sustainable. If it was sustainable, it would be simply incorporated into the regular dividend program. And while special dividends can be appealing in the short term, it's crucial to determine if these payouts indicate a potential for permanent increase in the regular dividend or if they're just a one-time event. To gain a clear understanding of a company's capability to generate this excess cash, a detailed analysis of its financial statements is essential. This should include examining revenue growth, profit margins, and debt levels and free cash flow. As well as this, a track record of consistent dividend payments, both regular and special, can reflect the company's dedication to returning value to shareholders. Dividends are a powerful way to grow your portfolio. Reinvesting dividends not only boosts your returns over time, but also acts as a reliable driver of gains, especially in more volatile markets. For dividend investors, today's sponsor, Stockopedia, simplifies the process of finding high-quality dividend-paying stocks. The dividend summary page provides a comprehensive overview of the company's dividend history and growth. You can easily track the dividend yield and cover through the financial summary section. This detailed analysis helps you assess the sustainability and attractiveness of a company's dividend profile, making Stockopedia an invaluable tool for building an income-focused portfolio. Stockopedia also offers a wide range of other excellent tools that can be used to help identify quality dividend-paying stocks. They have features like their stock screeners, which can apply technical analysis to let you know the best stocks according to different criteria. They also give a rank to each stock based on value metrics, so you can easily identify if they're a good buy. But more importantly, they do stock reports, which allows you to go in much more detail to highlight specific dividend info about a company. Viewers of the channel will also be entitled to a 25% discount and a 14-day free trial on any annual plan by using the link in the video description or by entering code CP25 at checkout. Some of these special dividends have been absolutely massive. Just so you understand the scale of these, here's the top 5 by size. The 5th biggest was in 2012 by Seagate Technology, a data storage company who wanted to return some cash to shareholders after a strong period. They paid a special dividend of $2.50 per share, which totaled around $1.1 billion, which is an insane amount of cash, and they keep getting bigger from there. 4th was Las Vegas Sands, who some may know as a giant casino and resort company. Again, in 2012, they paid a dividend of $2.75 per share, which is a total payout of $2.26 billion, part of a move to reward shareholders due to their strong cash position and financial health. 3rd was actually Costco Wholesale, who I'm sure need no introduction. They paid $10 per share in December 2020, which totaled $4.4 billion, a way for them to distribute their accumulated cash to shareholders. 2nd was a bit of a weird one, as it wasn't all special dividends but combined into a much larger dividend round. And this one was by Apple, and they did it over 2 payments, which was roughly $2.65 per share, but it totaled $4.9 billion. They also bought back a load of stock at the same time. And you're probably thinking, if Apple are number 2, who in the world is number 1? And this was actually the biggest special dividend of all time by a landslide, and this one was by Microsoft. In 2004, they paid a special dividend of $3 per share, which amounted to a total payout of roughly, wait for it, $32 billion. It was part of their plan to return $75 billion to shareholders over 4 years. To give you some context, that's the equivalent of $124,738,618,316 today, which is just mind-blowing. Of course, it's not like we would have missed out and got that in our back pocket, but still, $3 per share owned is pretty huge, considering the share price was only $18 per share. But looking at this, there's a glaring problem which you might have noticed. Is it really a good thing that they're paying out so much money? And this is where we need to consider something called opportunity cost. While special dividends can provide immediate cash flow to shareholders, they also come with opportunity costs. Opportunity cost refers to the potential benefits lost by choosing one option over another. In the case of a special dividend, the opportunity cost is the alternative use of the company's excess cash. A company could invest its extra cash in research and development, R&D, new product launches, expanding into new markets, or acquiring other companies. These investments could yield a better return or investment that helps the company grow and generates higher returns for shareholders over the long term by growing the company and the share price. By opting for a special dividend, the company may limit its ability to pursue these growth opportunities, and they potentially sacrifice future profitability and shareholder value. Another way a company could use its excess cash is by reducing debt. This improves the company's financial position, enhances its balance sheet, and can reduce its borrowing costs. This can add financial stability to the company, and it can be especially valuable during economic downturn, providing them with more security than a one-time dividend payout. And share buybacks are another opportunity cost to consider. When a company repurchases its own shares from the market, it reduces its outstanding number of shares, which can increase earnings per share and create an increase in demand versus supply. This often leads to a share price appreciation over time. In contrast, a special dividend does not reduce the number of shares outstanding and may not have the same long-term impact on the shareholder value. So while these huge payouts may seem fantastic, we also have to ask the question, why aren't they expanding or growing the company or paying off their debts instead? So we have to weigh up the pros versus the cons. Special dividends do offer several advantages for shareholders. When we receive unexpected cash payments from these companies, these payouts provide immediate access to additional funds that can be used either as income if that's our goal, or more likely to reinvest to get better returns. From an investment perspective, special dividends can lead to potential share price appreciation. When a company announces a special dividend, it can often signal strong financial health and success, which can boost investor confidence and attract more buyers, potentially driving up the stock price. However, it's important that we consider the potential drawbacks of special dividends as well. One disadvantage is a risk of misinterpretation by investments. Since special dividends are often viewed positively, investors may misjudge the true financial health of the company based solely on the dividend announcement. This can lead to overvaluation of the stock, which may not be sustainable in the long term. And additionally, special dividends can introduce volatility to the stock price. While the announcement of a special dividend may initially drive up the share price, the next ex-dividend date can lead to a decline in the stock price as investors sell their shares to capture the dividend payout. A company's stock price should, in theory, drop by the same amount as a special dividend on the ex-dividend date because of the cash distribution represents a proportionate decrease in the company's value, just as a normal dividend would. This short-term news can make market volatility. The one thing to step back here and consider is if the company is paying a special dividend, is it a one-off special event, like in the case of someone like Microsoft, or are they paying it because they have no other use for the cash? So how do you identify companies that might issue special dividends? There are several indicators you can watch out for. Look for companies with large cash reserves and low debt. Consistent profitability is also a good sign. Paying attention to company announcements and staying updated with financial news can give you a heads up on potential special dividends. Certain industries like technology and finance are more likely to issue special dividends, so keep an eye on trends within those sectors. A good sign to look out for is if they've paid a special dividend before. They could pay another one in the future. It's also worth considering the frequency of these special dividends. For example, Costco paid a special dividend 5 times in 8 years between 2012 and 2020, which is a good indicator they could do it again. You can also see within Stockopedia every dividend a company has paid and identify the special ones. But we should also consider how special dividends compare to other forms of capital returns that can be given to us as investors. Stock buybacks, for example, can also return value to shareholders, but in a different way. Buybacks can increase the stock price by reducing the number of shares outstanding, whereas special dividends provide us with a direct cash return. This will heavily depend whether you're a dividend investor wanting cash or someone looking for long-term growth. On the other hand, regular dividends provide consistent income, which for some investors they may prefer it because it's more predictable. Special dividends, on the other hand, are less predictable but can offer one-off significant returns to us as investors. Special dividends are almost looked at as a nice bonus to dividend investors, rather than something they can actively rely on for income purposes. So how can you make special dividends work for you as part of a larger investment strategy, and are they worth chasing? If you're keen on dividends, you can research and stay informed about potential special dividends. For example, if you're picking between two companies to give you a consistent dividend income and they paid a similar yield, if there's a toss-up between two companies, you could favour the one that's also paid special dividends in the past to boost your earnings. I don't feel like you can rely on these by any means, and I wouldn't recommend it. No one can completely predict how these will be paid, it's more of a best guess. If you're an ETF investor like me, for the most part, there's a good chance you'll have received multiple special dividends and you don't even know about it, as it's all just rolled into one. I own over 4,000 companies through my investments, so I'm subject to dividend cuts, dividend increases, special dividends, and all things dividend related without me even realizing it's happening. And within my accumulation version of my funds, that's automatically reinvesting the dividends, so I don't even notice purchase the ones I do get, it just gets increased in the share price. I do think, however, these are fascinating to look at and understanding how these things happen and what they mean for us. I always have a catch-22 as an investor when it comes to dividends, because I would love to go all in on something like dividends, but I just know long term they won't grow my portfolio as fast as passive index funds. So it's really not worth the hassle, unfortunately. But I do know how fun it can be to build up a monthly income of dividends, and I just would love to do it. So it does play on my conscience a lot. If you are interested in dividends, you may want to check out my ultimate dividend portfolio right here, where I broke down all of the best companies and the most reliable dividend payers. Even if you aren't, it's fascinating to see how much you could get paid every month. I hope you've learned something from this video. Let me know if you received any nice dividends in the comments, and thanks for watching. I'll see you there.